You've seen the signs. Fast cash now. Get approved in minutes. No credit, no problem. They seem to appear everywhere. On billboards, online ads, and storefronts in struggling neighborhoods. These are payday loan companies, and they promise something that sounds almost too good to be true. Quick money when you're in a tight spot. Maybe your car broke down before payday. Maybe rent is due tomorrow, and your bank account is empty. Maybe you just need $300 to get through the week. A payday loan promises exactly that. Fast relief with almost no questions asked. But behind the friendly slogans and easy approval lies a system designed not to help, but to trap. Every year, millions of people in America and around the world fall into the payday loan cycle. They borrow a few $100s and end up paying thousands in interest and fees. What seems like a short-term solution becomes a long-term nightmare. In today's video, we're going to uncover the truth, the 4 ways payday loans trap millions of people, and how the industry quietly profits from people's financial pain. Stick around till the end, because understanding this system could save you or someone you love from years of unnecessary debt. 1. The illusion of a quick fix. At first glance, payday loans look like a simple, harmless solution. You're short on cash and just need a little boost to get through to your next paycheck. The lender promises quick approval, often within minutes, and doesn't even check your credit score. It feels like someone finally understands your situation and is offering a helping hand. But here's the catch. Payday loans don't fix the underlying problem. They delay it. Imagine you borrow $400 to cover rent, expecting to pay it back in 2 weeks when your paycheck arrives. When that paycheck comes, you realize most of it is already committed: groceries, utilities, transportation. You can't afford to pay back the $400 and the $60 or $70 fee attached to it. So what do? You borrow again. That's the illusion. Payday loans are presented as a short-term solution, but they're designed to keep you coming back. It's not relief, it's dependency disguised as help. Instead of breaking the cycle of financial stress, payday loans tighten it, making it harder and harder to catch up each time. 2. Sky-high interest rates disguised as fees. Payday lenders are masters of language. Instead of talking about interest rates, they use words like service fee or finance charge. A typical payday loan might charge $15 for every $100 borrowed. That doesn't sound too bad, until you realize what it really means. Let's do the math. If you borrow $300, that's a $45 fee for 2 weeks. Sounds manageable. But if you convert that into an annual percentage rate, or APR, it comes out to roughly 391%. And if you can't pay the loan off and roll it over again, which many borrowers do, that rate effectively doubles, triples, and compounds. Compare that to the interest on a typical credit card, which averages about 20% APR. Even high-risk personal loans rarely go above 36%. Payday loans blow those numbers out of the water. Payday lenders rely on people not doing the math. They know when you're in financial distress, you're not calculating percentages, you're just trying to keep the lights on. But what they call a small fee is actually one of the most expensive forms of borrowing on the planet. Over time, those small fees drain hundreds, sometimes thousands of dollars from a borrower's paycheck, money that could have gone to groceries, rent, or savings. The quick cash becomes a long-term loss. 3. The cycle of renewal and rollovers. Here's where things get especially dangerous. Payday loans are almost never paid off on the first try. In fact, about 80% of payday loans are rolled over or followed by another loan within 2 weeks. That's not an accident, it's by design. When you can't pay back the loan in full, the lender offers to roll it over. That means you pay just the fee and extend the loan another 2 weeks. Sounds helpful, right? Except now you owe the same principal plus another fee. 2 weeks later, the same problem repeats. Before you know it, months have passed. And you've paid hundreds in fees without touching the original balance. This is the payday loan business model. They profit from the repeat borrower. Their goal isn't to lend to you once, it's to keep you in the cycle. Let's put it in real terms. Imagine you borrow $500. Over the next few months, You roll it over 5 times. That's 5 separate $75 fees, $375 total, and you still owe the original $500. That's money that could have gone toward bills, food, or savings, but instead, it went straight into the lender's pocket. It's like being stuck in financial quicksand. The more you try to pull yourself out, the deeper you sink. 4. Targeting the most vulnerable. Payday lenders don't show up everywhere. They're not in wealthy neighborhoods, near major corporate offices, or in high-income suburbs. They target specific areas, lower-income communities, areas with high unemployment, and places where people live paycheck to paycheck. They also cluster around military bases, because service members often face financial stress between deployments. This targeting is intentional. These communities are less likely to have access to traditional banking, credit cards, or emergency savings. Payday lenders fill that void, presenting themselves as the only option, and because the application process is so simple, no credit check, no collateral, it feels accessible. But that accessibility comes with a price. These companies exploit financial vulnerability, turning it into their business model. Worse, the impact isn't just financial, it's psychological. Borrowers often report feelings of shame, anxiety, and hopelessness. They know they're being trapped, but they can't see a way out. The lenders know that too, and they use it to their advantage. At its core, the payday loan industry is built on desperation. It thrives in moments of panic, when you need money fast and don't see another option. But what they don't want you to know is that there are other options. Community credit unions, nonprofit lenders, paycheck advance programs through employers, and even negotiating directly with your creditors. These are all safer, lower-cost ways to manage a short-term cash crisis. You might not get the money in 10 minutes, but you also won't spend months digging out of a financial hole. If this video opened your eyes to the payday loan trap, share it with someone who might need to hear it. The more we understand how these systems work, the stronger we become as consumers and communities. Remember, financial freedom isn't about having more money. It's about having more knowledge and control over the money you have. Thank you for watching. Take care of yourself, take care of your community, and always think twice before signing up for easy money.